Okay, let's talk about the S&P 500, which just blasted past 7,600. It's an incredible milestone, right? But underneath this euphoric rally, things are getting complicated. Global oil routes are choked. The European Central Bank is gearing up for a shock rate hike, and a massive liquidity drain is literally looming on the horizon. So as central banks start heading in completely opposite directions, the real question we need to ask is your portfolio actually prepared for what's coming?
7,600. That is a massive eye-watering record high, mostly fueled by this explosive AI and tech boom. Okay, let's dive into this, because when we peel back the layers and look at the underlying macroeconomic data, we really have to question the sustainability of this rally. The headlines are out there screaming endless growth, but the bond markets, well, they are flashing some serious warning signs.
So how exactly does a record market high clash with surging global bond yields and an incoming commercial real estate crisis? It's kind of a perfect storm. Right now, this massive AI stock rally is essentially masking a severe credit vulnerability in the system. Surging bond yields and this absolute flood of corporate debt issuance are draining systemic liquidity, and that is a direct threat to global real estate and highly leveraged equity sectors.
To make sense of it all, here is our roadmap for today's explainer. First, diverging global monetary policy. Second, the AI Capex debt boom. Third, real estate's refinancing wall. And finally, navigating the market volatility.
Real quick, just the standard disclaimer before we jump into the data. The information in this explainer is strictly not investment advice. Please always make your financial decisions based on your own personal risk profile. All right, let's get into Section 1, Diverging Global Monetary Policy. You know that era of synchronized central bank policy we got so used to? Yeah, that is officially dead. The rules of the game have completely changed. The biggest shockwave right now is coming straight out of Europe. The European Central Bank is preparing a shock rate hike to 2.25%. Why? To fight off surging 3.5% services inflation and energy costs. So even though their economic growth is weak, they are literally forced to tighten policy just to fight these entrenched price pressures. And this dynamic triggers what we call a bear steepening in the bond market. Put simply, when inflation risks are running hot and the supply of new debt is heavy, investors aren't just going to hand over their money for free. They demand higher returns to hold long-term debt. That pushes long-term yields up, which fundamentally steepens the yield curve. So we're seeing this stark, almost jarring divergence right now. You've got the U.S. Federal Reserve attempting to hold the line despite these massive fiscal deficits. But on the other side of the pond, the ECB is being forced to tighten monetary policy amidst real stagflation risks. This European tightening is acting like a magnet, pulling capital toward higher-yielding euro assets, which ends up weakening the British pound and pushing UK funding costs much higher. It is a massive global tug-of-war for capital. Let's move to part 2, the AI Capex debt boom, and see how this builds on that liquidity squeeze. Get this. The sheer scale of this corporate bond explosion is wild. Between 2020 and 2024, the 5 major AI hyperscalers issued an average of $28 billion in debt annually. Fast forward to 2025, that number skyrocketed to $121 billion. They are funding this massive AI build-out heavily with debt, acting like a giant sponge that's just soaking up market liquidity.
To put that into perspective, AI-related debt has now hit a staggering $1.2 trillion. That makes up a massive 14% of the entire high-grade corporate bond market. Now, yes, these are highly rated companies, but the sheer concentration of this debt is definitely increasing idiosyncratic credit risks. Simply put, it leaves a lot less liquidity floating around for everyone else.
Goldman Sachs actually laid this out perfectly recently. They noted, the core narrative driving global markets is transitioning from a pure AI Capex expansion boom toward a framework dominated by interest rate and bond supply pressures. Even the major institutions are seeing this initial AI euphoria starting to subside, being replaced by the very sober, undeniable reality of bond math.
Hey, real quick, if you're finding this breakdown helpful, please don't forget to subscribe to the channel, hit that like button, and share this explainer with someone who needs to hear it. Okay, let's move on to the critical action plan and look at the sector most vulnerable to all of this. Section 3, Real Estate's Refinancing Wall. Because the AI euphoria is really masking a severe credit vulnerability in the property sector. The industry is facing a massive maturity wall, which is basically a rolling wave of debt coming due all at the exact same time.
During 2023 and 2024, lenders relied heavily on extend and pretend strategies to avoid defaults. It was essentially financial hide-and-seek. But guess what? The clock ran out. Borrowers who locked in 3% loans are now facing 7% rates, all while their underlying property values have dropped.
When you break down this $930 billion commercial real estate maturity wall for 2026 alone, it's pretty alarming. The multifamily sector has $162.1 billion coming due. That is surging 56% from last year, and they're facing massive loan-to-value valuation gaps. And depositories, specifically regional banks, they hold $396 billion of this risk. If these properties start defaulting, it hits the regional banking sector squarely in the jaw.
So, the crucial point is understanding the exact math of a typical multifamily property refinancing today. Step 1. A property originally bought for $50 million drops in appraised value to $42 million. Step 2. Refinancing interest rates have jumped up to 7%. Step 3. Because lending standards are way tighter now, the new loan maxes out at only $27.3 million. Which leads to Step 4. The borrower is now staring at a $10.2 million funding gap. If they can't inject fresh, out-of-pocket cash to cover that gap, they default.
And this creates a profound dislocation in the market. Right now, liquid corporate bonds are yielding around 5.22%, while illiquid net lease real estate properties have cap rates around 6.80%. Investors are looking at that and demanding much higher risk premiums to lock their money into illiquid assets, especially when they can get relatively safe, high yields over in liquid bonds.
Which brings us to our final section, Part 4, Navigating the Market Volatility.
With central banks diverging, AI Capex draining liquidity, and this real estate maturity wall looming, we can look to veteran investor Ray Dalio for some perspective. He says all great technology changes produce bubbles because nobody can get it right in pricing the future. This AI boom absolutely is revolutionary, no doubt. But as bond yields rise, they start acting like gravity pulling down on those sky-high stock valuations.
And this brilliantly illustrates what market analysts are suggesting we do right now. They are saying to execute a defensive cash flow structure today. Shift excess capital into money market funds for that safe yield. Build a physical gold hedge to protect yourself. Prepare dry powder. Keep cash on the sidelines so you can acquire global dividend ETFs at a discount during the next major liquidation event. And finally, utilize a barbell strategy, balancing short-duration liquidity with intermediate bonds.
Ultimately, it comes down to a choice between two paths. You can be chasing the market euphoria, which leaves you completely exposed to stealth inflation and margin debt traps, or you can practice delayed gratification, protecting your purchasing power with physical gold and building rational, defensive asset structures that can actually absorb the incoming volatility. The overarching takeaway from all the data we've reviewed today is loud and clear. Do not chase the market euphoria. The underlying mechanics of the global economy are shifting right under our feet. The focus right now must be to protect your purchasing power against stealth inflation, avoid the margin debt trap, and structure your assets to stay entirely rational as that systemic liquidity continues to drain.
We are watching a massive macroeconomic convergence play out in real time. So, as global central banks diverge and a $1 trillion real estate debt wall crashes into the market, is your portfolio actually built to survive the 2026 liquidity drain? Thank you so much for joining me on this explainer. Stay objective, stay prepared, and I'll see you in the next one.